into the next section of this chapter, chapter 11, where we're talking about bonds. More specifically, we're talking about accounting for bonds, okay? So here's our next example. It says on January 1st, year one, Northern Idaho Transportation Inc. issued the following bond. So we have all of this information here, and it says the face amount is $100,000. We have the contract rate of interest at 12%. This bond will pay semi-annual interest on those two dates. The term of the bond is 5 years, and the market rate of interest 11%. So as we've discussed in the prior videos, when looking at information like this, we need to ask ourselves 3 questions. Number one, the 3 questions, I guess, is it sold at a discount? Will it be sold at a face amount, or will it be sold at a premium? And to initially get through this kind of phase, you need to compare what the contract rate of interest is, which is 12%, which is what Northern Idaho Transportation is offering to the investors. And then you need to compare that same percentage to the market rate of interest, which is 11%. Remember, the market rate of interest is dim. Everybody else that's in, in the market to sell bonds. And so based on this information, Northern Idaho Transportation, their interest rate is a lot higher than what the market is by 1%. So therefore, investors will likely want to pay a premium because the interest rate is higher. So therefore, this bond will sell at a premium. Now let's assume the bond sells for $103,769, okay? Now, as I mentioned when we were talking about a discount, when you're looking at the premium amount, this is the amount I must provide you with. Do not try to come up with it or multiply it or calculate it. I will provide it to you, okay? Now let's see how we're going to capture this journal entry, okay? So in order for us to capture this, we're going to do a debit of cash, the cash that we're receiving from the market or from the investors. And then as you can see, this is over and beyond what we have asked for. And the reason for that is our interest rate is higher. So then we're going to do a credit of bonds payable. And then the difference represents the premium dollar amount that we receive for having a higher rate of interest than the marketplace, okay? So the premium on bonds payable is normally a credit balance. And so similar to what we did for the bond discount, whenever you have a bond payable, if you add that to the premium, that will be your carrying amount, okay? So just as a reminder, when a bond issued at a discount or a premium of the face amount, the amount will be amortized over the life of the bond. So for us, this $3,769 will be amortized just as we did for the discount on bonds payable. At maturity, even if the investors paid us a premium for this bond, we will only repay the face amount of the bond, which for us is $100,000, okay? All right, so amortizing the bond premium, again, looks exactly the same, except the journal entry is a little bit flipped, right? So now we're doing a debit to the premium on bonds payable and a credit to interest. We are reducing our interest expense, as in we're reducing our expenses by doing a credit because we've received a lot of money up front, right? We've received a premium up front. And so therefore you can't double dip, right? You can't have a tax write-off in terms of expenses as well as capture the extra money from the market, okay? All right, so let's try to capture this in this particular example. So as we did with the last one, we're going to take the full amount of our bond premium, which is the $3,769, and we're going to divide it by the number of periods. Remember, we're amortizing this particular bond semi-annually. So the way we came up with the number of periods, right, is by doing the term of the bond, which is 5 years, and we're going to amortize it twice a year, 2 periods a year, and the total equals 10 periods. And that's what goes here. So once we do that calculation, it will be $376.90. That is the amount that we will amortize over the life of the bond. So if I had to do a T account of what this looked like, we have our account of the premium on bonds payable, right? And when we initially recorded it, it was a credit, right, of the $3,769. At the end of this bond, this premium must be down to zero. So twice a year, every year, on June 30th and December 31st, we're going to amortize $376.90 until we're at the end of the bond, until it's zero. So this is year one, and then we're going to have another set year two until it's zero. Okay, so hopefully that makes sense. All right, so I kind of copied over a lot of this, but what I want to make sure I now do is show you how to combine this journal entry. So what I'm going to do is now flip over to a blank screen, and we're going to capture this journal entry. Okay, so first off, I need to, as we mentioned before, we need to capture the issuance. So we're going to do a debit of cash of the 103,769. That's how much we received. And then we are going to do a credit of bonds payable in the amount of 100,000. And if you're stuck here right now and you're a little lost, you know, in order to balance this, you need another credit of $3,769. And that represents the premium on bonds payable. Okay. Now our next journal entry is to give the interest to investors. And so to do that, what did not change is our interest expense. So remember, the way to calculate that is we're going to do the face amount, which is the face amount of this particular bond. We're trying to calculate, oopsie. Okay, so it's going to be the face amount of 1,000 times the interest rate. We say it was, I think, 12% times 1/2 of the year, and that comes out to 6,000. That's what we're promising our investors twice a year, every year for the next 5 years. So to capture that, we're going to do a debit to interest expense in the amount of $6,000, and then our credit is going to be to cash, $6,000. All right, so this is for our investors. All right, the other part we need to capture is this bond premium, the amortization of that. Now that one looks a little bit different. We're going to do a debit to premium on bonds payable in the amount of, I think we calculated as $376.69 divided by the 10 periods equals $376.90, right? All right, so that's going to be $376.90, and then our credit is going to be interest expense. Okay, and this is the premium amortized. All right, and then last but not least, what we need to capture is our the repayment, right? So of the bond, and to capture that, we're going to do a debit to bonds payable in the amount of $100,000, and then our credit is going to be of cash, $100,000. Now, what I want to pay particular close attention to is how do we combine these two journal entries, right? And it follows the same logic as we did last time. However, your interest expenses are clashing against each other, right? So you have a debit and then you have a credit. So what you're going, it's going to look a little bit different. So I'm going to do another one and show you what this the combined journal entry is, okay? So to get that, remember, if you have your T account and you have interest expense, if you want to see it this way. Okay, we have a debit and we have credit. So our debit was $6,000, and then we had a credit of $376.90, right? So the difference represents us trying to combine those journal entries. So once we do this calculation, it should come out to $5,623.10. Okay, so that's me trying to show you how to capture it together. Now, if I'm going to write it all out, it's going to be on June 30th, and then again on December 31st. My journal entry to capture all of my interest is going to be a debit to interest expense in the amount of $5,623.10. And my credit is going to be to, I have another debit of premium of bonds payable in the amount of $376.90. And then my credit is going to be to cash of $6,000. Okay. So hopefully that makes sense to you. Okay. And so if we're looking at here, sometimes my handwriting isn't the best, but this is showing them combining the interest from the investor and also the amortization of the premium on bonds. Okay. So with that, we're going to do a breakout session so we can get a better understanding of how to journalize all of this. So in the next video, come with me now as we do the example number 3.